Hello and welcome. In this video, we're going to be talking about restricted stock units. Restricted stock units have become a popular vehicle used to incentivize and reward highly valued employees. In this video, we're going to be covering how exactly restricted stock units work, how they operate, and some really important tax information that you'll want to be aware of. Important to note, restricted stock units are different than restricted stock awards. And we'll actually be covering restricted stock awards in our next video. So if you're not a subscriber, go ahead and hit that subscribe button so you get notified of when that comes out, which will be happening very soon. My name is Rick Vazza. I'm a certified financial planner and president of Driven Wealth Management. We're a San Diego financial planning and investment management firm where we help driven professionals and entrepreneurs create and maintain generational wealth. Restricted stock units are a big part of ultimately creating that for many of the employees that we work with that work for a large publicly traded corporation. So what I wanted to do today is just take you through some examples that I think will be really helpful in highlighting exactly what these powerful wealth building units are. All right, so first off, what exactly are restricted stock units? It's important to understand restricted stock units are the promise of you receiving stock at a future date. That's typically going to be based on timeline. So normally there's some sort of vesting schedule associated with their units. And this vesting schedule works very similar to your 401k, for example, where it's typically over a certain amount of time that you're with the company, a certain amount of those units vest and actually become yours, while the other units remain unvested, where they're technically not yours if you were to leave the company. And there's two common features. There's the gradient schedule and the cliff schedule. And I'll walk you through those so that you can see what I mean. It doesn't matter if you don't have a 401k or don't have a vesting schedule, not familiar with it, kind of take you through that and show you what it looks like. An example probably will work best, in fact. Now, a lot of popular companies are using restricted stock units, but let's just use an example. One that I'm pretty familiar with is Microsoft. So let's say you are a new Microsoft employee, and you have been incentivized through, number one, their competitive compensation structure. So let's just say they hypothetically offered you $150,000 as your base salary. But then in addition, they say, we're also going to give you 500 shares of these restricted stock units. And you're kind of wondering, well, what exactly are those? Is that a good thing? Am I excited by this? What exactly does this mean? So number one, yeah, these are great vehicles, and what they're really designed to do, and the intent of the restricted stock units, is to align your performance with the company's performance. Ultimately, the idea thinking, hey, you're a key employee. If you would do a good job, the company should do a good job. In turn, the stock price should do well. So if all those things happen, the stock price does well, there's actually an opportunity for these units to be more valuable than if the company were to just give you cash, for example. I'll explain what that looks like. So as I mentioned, there's typically, though, not all of these shares are coming to you at once. So they'll say, you're going to get the 500 shares, but we have a schedule that we follow in which those shares will actually become yours. And I'm familiar with Microsoft, so what Microsoft does in particular, they say, we will provide you 25%, or in this case, what is 125 shares, after year one. So after your first year of service with the company, you'll receive those units. Now, the nice thing to know, though, is obviously the performance of the company is important. So they're kind of incentivizing you to do your job well because, again, if you do well, ideally the company does well, the stock price does well. What could start as one figure could ultimately become a very larger and significant figure by ultimately the end of the year, and especially over multiple years where these would typically happen. And I'll show you what I mean by that. So now, with Microsoft in particular, what they do is they have a bit of a unique schedule. It actually works in the favor of employees, so employees at Microsoft should be happy about this, where they'll have their shares vest over a period of 4 years. But instead, what a lot of companies will do each year, there will be additional shares vested. Microsoft actually does it each quarter, which is fairly unique, and they'll have 6.25%. Or in this case, it's about 31.25 shares, which vest every 3 months, so each quarter. And you'll notice with the math, the way that works, so after the end of 4 years, all 500 of those shares would ultimately be the employees at that point. So it's a really nice thing in this case because what happens is when they vest, they actually become yours, meaning if you were to leave the company, you would still own those shares outright. Whereas, if you had to wait a year, 2 years, 3 years, you ultimately may leave the company before then without the shares becoming yours. Now, ideally, Microsoft's reason for doing this is to incentivize you to stick with the company long term and see the rewards of your efforts pay out with a rising share price. So it is designed to align those interests, and oftentimes it does work in that way. But this is basically what we would call a gradient vesting schedule. So as you can see here, a percentage of the shares are vesting over time. When I'm saying vesting, that means they're actually becoming yours. A company like Microsoft will partner with a brokerage firm. In this example, Microsoft, I know, partners with Fidelity. So the employees of Microsoft who have these RSUs will have an account with Fidelity. When those shares vest, they will then be transferred to Fidelity, and that's ultimately where the shares will lie, if you will, for the employee to then take action on. So that covers what exactly these are, why they can be so powerful. Well, if you think of just an example here of why this is different from a strictly cash bonus and how there's that nice alignment of interest with the potential growth of the company. So Microsoft, just using as an example here, we see that as of the close of trading today, we have a share price of about $26 per share. Well, Microsoft started the year at about $160 per share. So if you think about it, if they had just given you the cash bonus up front, you do the math, 160 times 500. But instead, because you have the benefit of now the company performance over the year, what would have been a lower cash payout is now higher because the share price has risen. And so the value of those 500 shares is now worth a lot more. Instead of it being 500 times 160, it's now 500 times 226. So you can see with the idea being, hey, if you're doing a job, the company's doing a job, the share price does well, that alignment of interest ideally is going to create a situation where these units are worth more than cash otherwise would be outright. So that's kind of a nice big benefit of this process as far as why they can be so valuable. Now, the question becomes, well, how do they exactly work? I've mentioned that they're not really yours until they vest. Well, there's some really important things that happen upon vesting that you should be aware of. So let's use an example of these 500 shares. And I've talked about how after year one, 125 of those shares will vest. So let's fast forward through this employee's career, and now it's year one. And they are going to receive those 125 shares that they would be now vested to them. So 125, let's actually do the math here because this will be important, times, let's just say in this case, we're playing with the year-end value. We'll fast forward and say it's still at 226. So this employee received now a benefit worth $28,250. Important to note that now is taxable in the year in which it vests. So if that 1 year hit on the vesting in the year 2020, that would be 2020 taxable income. And it's just like receiving an additional paycheck. So that was now a paycheck of $28,250. And that's really important to note because, as I mentioned, they were also already receiving that competitive base salary. So one of the things that's really important about restricted stock units is you want to project out that vesting schedule and get an idea of what that, in theory, based on where the price is now, what does your projected tax liability look like? Oftentimes I can run into people who are under appreciating the tax that they might owe because they didn't really recognize that this would be included in their taxable income. So Microsoft is actually going to help you with this to some extent. Depending on which tax bracket you fall into, there's going to be an automatic withholding requirement. In most cases, they're going to withhold 22% automatically. That's going to be for federal tax. Now, recognize this is, although you will owe tax on federal and state. So people like in the state that I live in, California, there is going to be a typically a decent amount due for California tax that you don't want to overlook. So again, that's why the tax projections can be really important. So 22% for federal tax, and then oftentimes we're going to run into 7.65, so 0.0765 is for the FICA tax. So that includes like Social Security and Medicare, and FICA will also be withheld. So typically of that, 28,500. The company will automatically deduct that $8,376.13 on your behalf. That will be used towards those two areas of taxation. Now recognize that you may not have withheld enough. Like I said, you may be in a higher tax bracket, so you may have some additional tax technically due. So it could be important to set aside a reserve fund to ultimately pay that tax come April. That's just something to be aware of. Or maybe you're not in the 22% bracket and you may be withheld too much. So in that case, you get a refund in that case. So just something to be aware of. Now, how are they withholding that? Well, what they're actually going to be doing is withholding the number of shares that you would have received. So remember, in this case, we said this was for 125 shares. Because that was 125 times 226. So in this case, we can figure out how many shares they're going to be withholding by simply taking that amount and then dividing by 226. Now, important to note, they're always going to round up on the amount of shares because they want to make sure they cover the tax that they owe, not that they are under withholding. So in this example, it's because it's 37.06 shares that they would be withholding. They're actually going to typically round that up to 38, which in theory will change our number a little bit here. What will happen is, in that case, the difference, because now you can see they're withholding too much because they only needed to withhold 37.06. Now they're withholding too much. That difference will automatically be applied towards the additional tax withheld. And so then what will happen is you will have the leftover of that, which in this example is 87 shares. Deposited into your account. And now just to give you an idea, based on that 226 figure, that means, what was your initial $28,250 payout has now become $20,000 after we account for the taxes owed. A lot of people complain about this. Recognize, though, this would be the same exact situation if you were to receive cash. You'd still owe tax on that. So I don't want you to think you're getting shortchanged here or that restricted stock units are causing any sort of problem like you're losing out. That's not the case whatsoever. They're actually doing you a bit of a benefit here because you have to pay that tax come April anyways. They're just automatically doing this. I mean, you could argue, would you prefer to hold that off or not? That's certainly understandable. But recognize you're not getting shortchanged as if this were a cash payout, which I think is really important. And a lot of people who aren't familiar with the process tend to think that on initial first glance. So ultimately, you'd receive those 87 shares. In this case, they'd hit that Fidelity account, and that would be what you'd be looking at from a account value standpoint. They'd have the 87 shares listed and the roughly call it $20,000 of market value. Now, once those shares hit your account, that's technically day one of you owning those shares. Up until that point, you didn't own these shares. You owned units that promised you shares if certain milestones were hit. So at that point, it's just like as if you were to buy individual stock in a normal taxable account. You are going to be assigned cost basis in those shares of $226 per share. The price at which these are worth when they vested, and that's your starting basis from there on. If the stock price grows and you sell those shares within a year, you're going to owe short-term capital gains, which are taxed at your ordinary income rate. If you decide to hold those shares and sell them after a year and the price grows, you'll receive long-term capital gains. So it works just like any other stock in that regard. Now, what you may want to do, if you already have a sizable amount of shares and exposure to the company, you may want to turn around and sell those shares and reinvest them into something else. Because after day one, for example, day two, there's likely not going to be a significant gain. So there really wouldn't probably be any serious tax ramifications of turning around and selling the shares after you obtain them. And that's pretty common that I'll have clients that we ultimately decide to sell those because they'll already have a big chunk of exposure to the company through the additional unvested shares. So we'll turn around and sell those and reinvest them into a more appropriate investment vehicle. That totally is client dependent, depending on circumstances. I have some clients who don't have a lot of exposure to their company. Maybe they're at the end of a vesting schedule, so they've decided to keep them because they have a lot of conviction in the company. It's not a sizable exposure to their net worth. General rule of thumb, I don't typically like to see a single position, an individual stock represent 5% or more of a client's net worth if they don't have direct control over that position. For example, if they're like the owner of the company, if it's a small business, that's oftentimes a different conversation. But if it's a public company that they don't have any control over, oftentimes you're getting over 5%. That might be taking an additional unnecessary risk that you don't really need to take on. So just a good rule of thumb. So ultimately, once that happens, just like any other stock, now though you've had all of the benefit of the potential appreciation, assuming you're doing a great job, hopefully you're helping to contribute to that appreciation. Yeah, you can see how these can be, hopefully you can see how these can be very powerful rewards and benefits to employees, and particularly in key positions, which is ultimately what the companies are trying to reward. So I hope you found this information helpful. If you have any questions, as always, please go ahead and drop the questions in the comment section. I'll be happy to chat. If you really want to take the discussion further, feel free to go ahead and schedule an appointment with us. You can always reach us. Easiest way directly is on our website at drivenwm.com. Thanks again. And again, if you are wanting to get more of this information, be sure to hit that subscribe button so that you'll be alerted as we continue to update our growing video library. All right, thanks, and we'll talk again soon.